Welcome to Hedge and Haven, your go-to channel for the juiciest billionaire secrets, luxury real estate scoops, and tax-saving strategies that the ultra-rich don't want you to know. Today, we're diving into a financial titan that's shaking up global markets. Norway's $1.4 trillion sovereign wealth fund, often called the world's biggest investor. In the next 75 minutes, we'll unpack how this fund, built on oil money, became a global powerhouse, owning 1.5% of all listed companies worldwide. We'll explore its massive investments, its bold 2025 strategy, and the controversies that have experts buzzing. Think climate protests, ethical dilemmas, and a $12 billion loss in one day. Is Norway's fund the ultimate safe haven for investors, or is it a ticking time bomb? Stick around to find out, and don't forget to smash that subscribe button for more financial deep dives every Tuesday at 9 a.m. EST. Let's set the stage with some jaw-dropping numbers. As of April 2025, Norway's government pension fund Global, commonly known as the Oil Fund, is valued at $1.4 trillion, according to Norges Bank Investment Management, the fund's manager. That's right, trillion with a T. To put that into perspective, if you stacked $1.4 trillion in $100 bills, the pile would stretch 950 miles high, enough to reach outer space. This fund owns about 1.5% of all publicly listed companies globally, from Apple to Toyota, making it the single largest shareholder in the world's stock markets. It's so big that it holds stakes in over 9,000 companies across 70 countries, with investments in tech giants like Microsoft, luxury brands like LVMH, and even renewable energy firms like Tesla. But how did a small country of just 5.5 million people build such a colossal financial empire? And more importantly, what does it mean for global markets in 2025? Let's dive into the origins of this fund and how it became the king of investments. Norway's sovereign wealth fund was born in the late 1960s when the country discovered massive oil reserves in the North Sea. The first deposit into the fund was made in 1996, but the real growth kicked off in the 2000s as oil prices soared. The fund's purpose was simple yet genius: save Norway's oil revenues to ensure wealth for future generations, long after the oil wells run dry. Today, the fund is worth about $250,000 per Norwegian citizen, making it a nest egg that secures the country's welfare system, from healthcare to education. Unlike other oil-rich nations that splurge their petrodollars on flashy projects, Norway took a disciplined approach, investing its oil money globally to diversify its economy. The fund is managed by Norges Bank Investment Management, led by CEO Nicolai Tangen since 2020, who's known for his bold strategies and a personal art collection worth millions. But managing a $1.4 trillion fund isn't all smooth sailing. There are risks, controversies, and massive expectations. So how exactly does this fund make its money? Let's break down the fund's investment strategy, which is a masterclass in diversification as of early 2025. The fund allocates 70% of its portfolio to equities. That's about $980 billion invested in stocks worldwide. Tech stocks are a big chunk, with the fund owning 2.8% of Apple worth $90 billion, 1.9% of Microsoft, $60 billion. It also has a 1.5% stake in Tesla, valued at $12 billion, showing its bet on green tech. Another 27% of the fund, or $378 billion, is in fixed income assets like government bonds, providing stability during market downturns. The remaining 3%, about $42 billion, is split between real estate and renewable energy projects, including luxury properties in New York, London, and Paris, and wind farms in the North Sea. In 2024 alone, the fund earned a return of 16%, adding $200 billion to its value thanks to a booming stock market. But here's the catch. When markets tank, so does the fund. In January 2025, it lost $12 billion in a single day due to a tech stock sell-off, raising eyebrows about its risk management. How does the fund balance these ups and downs? One of the fund's key strengths is its long-term approach. Unlike hedge funds that chase quick profits, Norway's fund thinks in decades, not quarters. It's designed to weather market volatility with a rule that the Norwegian government can only withdraw 3% of the fund's value annually, about $42 billion in 2025, to fund public services. This ensures the fund grows over time while supporting Norway's economy. The fund also has strict ethical guidelines, overseen by a council of ethics, which has led to divestments from companies involved in tobacco, nuclear weapons, and coal. For example, in 2024, it sold off $1.5 billion in coal-related stocks, aligning with its sustainability goals. But these ethical rules have sparked debates. Some say they limit returns, while others argue they set a global standard for responsible investing. In 2025, the fund plans to invest $20 billion in renewable energy, aiming to triple its green portfolio by 2030. Will this shift to sustainability pay off, or is it too risky for a fund of this size? Let's talk about the fund's real estate investments, which are a hidden gem in its portfolio. As of 2025, the fund owns luxury properties worth $15 billion in cities like New York, where it holds a stake in Times Square buildings, and London, where it owns parts of Regent Street. In Paris, it has a $2 billion stake in Avenue des Champs-Élysées properties, catering to high-end brands like Louis Vuitton. These investments aren't just about prestige, they generate steady rental income, with yields averaging 4% annually, or $600 million in 2024. The fund is also expanding into logistics, buying warehouses in the USA to capitalize on e-commerce growth, with a $3 billion investment plan for 2025. But real estate isn't without risks. Rising interest rates in 2025, with the U.S. Federal Reserve hiking rates to 5%, could lower property values, potentially costing the fund $1 billion in losses. How will the fund navigate this high-stakes market? Now let's zoom in on the fund's tech investments, which are a major driver of its growth. The fund has heavily bet on the tech sector, with $300 billion invested in companies like Apple, Microsoft, and Amazon as of April 2025. Its 2.8% stake in Apple alone is worth $90 billion, making it one of Apple's largest shareholders. The fund also owns 1.9% of Microsoft's $60 billion and 2% of Alphabet $40 billion, showing its confidence in AI and cloud computing. In 2024, tech stocks helped the fund earn a $100 billion profit, thanks to a 20% rally in the Nasdaq. But tech is a double-edged sword. In January 2025, a 5% drop in tech stocks led to that $12 billion loss in a single day, the fund's worst daily performance since 2022. With tech valuations at all-time highs, Apple's price-to-earnings ratio is 35, compared to the S&P 500 average of 25. Some analysts warn of a bubble. Will the fund's tech-heavy strategy hold up in 2025, or is a crash looming? The fund's renewable energy push is another big focus for 2025, aligning with Norway's green ambitions. Norway aims to be carbon neutral by 2030, and the fund is playing a key role by investing $20 billion in renewable projects this year. It's already a major player in offshore wind, owning stakes in wind farms in the North Sea and the Baltic Sea, valued at $5 billion. In 2024, these projects generated $200 million in revenue, with plans to double that by 2027. The fund is also investing $3 billion in solar farms in the USA and Australia, targeting regions with high solar potential. But green investments come with challenges. Returns are lower than tech stocks, averaging 3% annually, and projects take years to mature. Plus, political tensions over climate policies, like the used carbon tax, could add costs. Is the fund's green pivot a visionary move, or a gamble that could hurt its returns? Let's not forget the controversies surrounding the fund, which have sparked global debates. One major issue is its investments in companies linked to environmental damage. Despite its ethical guidelines, the fund still holds $10 billion in oil and gas stocks, including a 1.2% stake in ExxonMobil, worth $5 billion. Climate activists, especially in Norway, have protested this, with 5,000 people marching in Oslo in March 2025, demanding a full divestment from fossil fuels. The fund's response? It plans to cut its oil and gas holdings by 50% by 2030, but critics say that's too slow. Another controversy is its investments in tech giants like Meta and Amazon, which face data privacy scandals. In 2024, the fund faced pressure to divest $2 billion from Meta after a privacy lawsuit in the EU, but it held firm, citing financial returns. These ethical dilemmas raise a big question. Can the fund balance profit with principles in 2025? Another hot topic is the fund's role in global markets, especially as an activist investor. The fund isn't just a passive shareholder, it uses its massive stake to influence corporate behavior. In 2024, it voted against 500 CEO pay packages it deemed excessive, including at Apple and Tesla, pushing for more transparency. It also pressured companies like Amazon to improve labor conditions, threatening to sell its $10 billion stake if changes weren't made. In 2025, the fund plans to double down on this activism with a $1 billion budget to lobby for climate-friendly policies at shareholder meetings. But this approach has risks. Some companies, like ExxonMobil, have pushed back, accusing the fund of overstepping. Could this activism backfire, or will it set a new standard for global investing? Let's talk about the fund's performance in 2025 so far, which has been a roller coaster in the first quarter of 2025. The fund earned a 5% return, adding $70 billion to its value, driven by a rally in tech and real estate. But that $12 billion loss in January showed its vulnerability to market swings. Analysts predict the fund could hit $1.5 trillion by the end of 2025 if global markets remain stable, but there are headwinds. Inflation, at 3% in the USA and 2.5% in the EU, is squeezing bond yields, which make up 27% of the fund's portfolio. Rising interest rates, 5% in the USA, 4% in the EU, are also a concern, as they could hurt real estate and tech valuations. On the flip side, the fund's renewable investments could benefit from $100 billion in global green subsidies in 2025, boosting returns. What does this mean for the fund's future? Let's explore the economic context for 2025, which will shape the fund's performance. The global economy is expected to grow at 3.2%, according to the IMF, with the USA leading at 2.8% and the EU at 1.5%. This growth supports the fund's equity investments, especially in tech and consumer goods. But there are risks. China's economic slowdown, with GDP growth at 4.5%, could hurt luxury stocks like LVMH, where the fund has a $5 billion stake. Geopolitical tensions like the Russia-Ukraine conflict are driving oil prices to $90 per barrel, which benefits the fund's $10 billion oil holdings, but clashes with its green goals. Meanwhile, the US dollar's strength, up 5% against the euro in 2025, boosts the fund's returns on US investments, but hurts its European assets. How will the fund navigate these global trends? The fund's impact on Norway itself is another fascinating angle. With $1.4 trillion in assets, the fund is a safety net for Norway's 5.5 million citizens, funding everything from free healthcare to education. In 2025, the government plans to withdraw $42 billion, 3% of the fund's value, to balance its budget, especially as oil revenues dip with the global shift to renewables. But this withdrawal rule has sparked debate. Some Norwegians, facing a 4% cost of living increase, want more spending on welfare, while others warn that overspending could deplete the fund. A 2025 survey by Norstat found that 60% of Norwegians support keeping withdrawals at 3%, while 30% want an increase to 4%, which would mean $56 billion. How will this tension play out, and what does it mean for Norway's future? Let's look at the fund's leadership, which plays a big role in its success. Nicolai Tangen, the CEO since 2020, is a finance rock star with a net worth of $800 million and a personal art collection of 4,000 pieces, including works by Picasso. Tangen has pushed the fund towards sustainability, tripling its renewable investments since taking over. But his tenure hasn't been without drama. In 2020, he faced backlash for hosting a lavish seminar with Anthony Scaramucci before taking the job, raising questions about conflicts of interest. In 2025, Tangan plans to increase the fund's stake in emerging markets like India and Brazil, allocating $10 billion to tech startups and infrastructure. But emerging markets are volatile. India's stock market dropped 8% in Q1 2025 due to political unrest. Will Tangan's bold bets pay off, or are they too risky for a fund meant to protect Norway's future? The fund's transparency is another reason it's admired globally. Unlike many sovereign funds, Norway's fund publishes detailed annual reports showing every investment down to the penny. In 2024, it released a 300-page report detailing its $980 billion in equities, $378 billion in bonds, and $42 billion in real estate and renewables. This transparency has won praise. IMF chief Kristalina Georgieva called it a model for governance in 2024. But it also makes the fund a target. Hackers attempted to breach its systems in 2023, though no data was stolen. In 2025, the fund is spending $50 million on cybersecurity, including AI-driven threat detection, to protect its assets. With cyber threats rising, ransomware attacks are up 30% globally. Can the fund stay secure? Let's dive into the fund's social impact, which often gets overlooked. The fund's investments have created jobs worldwide. Its $5 billion stake in Tesla, for example, supports 10,000 jobs in the USA, according to a 2024 Tesla report. In Norway, the fund's withdrawals fund 20% of the national budget, paying for 50,000 teachers and 30,000 nurses annually. But there's a flip side. Its investments in companies like Amazon, which has faced labor strike protests in Germany, have drawn criticism. In 2025, German unions are demanding the fund divest its $10 billion Amazon stake, citing poor working conditions. The fund has responded by engaging with Amazon, pushing for better labor policies, but no divestment yet. How will this tension affect the fund's reputation? Another angle is the fund's influence on global sustainability trends. By investing $20 billion in renewables in 2025, the fund is signaling to the world that green tech is the future. This move has already inspired other sovereign funds. Saudi Arabia's Public Investment Fund announced a $10 billion green fund in March 2025, citing Norway as a model. The fund's also a leader in ESG, environmental social governance, investing, with 90% of its portfolio meeting ESG standards, according to a 2024 report by Morgan Stanley. But ESG investing has critics. Some argue it sacrifices returns, as green stocks often yield 3% compared to tech's 10%. In 2025, the fund's green investments are expected to grow 5%, adding $1 billion in value, but that's modest compared to its tech gains. Is the fund's ESG focus a moral win or a financial misstep? Let's talk about the fund's competitors, because it's not the only player in the sovereign wealth game. China's investment corporation, valued at $1.2 trillion, is a close rival with a focus on tech and infrastructure in Asia. Saudi Arabia's Public Investment Fund, worth $900 billion, is another contender, investing heavily in sports and entertainment, like its $2 billion stake in Formula One. Norway's fund stands out for its transparency and ethical guidelines, but its competitors are catching up. China's fund earned an 18% return in 2024, outpacing Norway's 16%. In 2025, Norway plans to increase its stake in emerging markets to compete, but volatility in places like Brazil, where inflation hits 6%, could hurt returns. How will Norway stay ahead in this global race? The fund's role in tax savings is a big draw for our audience at Hedge. Norway's tax system is famously high. Top earners pay 55% in taxes, but the fund ensures long-term financial stability, reducing the need for even higher taxes. For global investors, the fund's structure offers lessons in tax efficiency. By investing oil revenues globally, Norway avoids over-reliance on domestic taxes, a strategy individuals can mimic by diversifying investments offshore. In 2025, the fund's $378 billion in bonds includes $50 billion in tax-free municipal bonds in the USA, earning $2 billion in tax-free income for our viewers in the USA, UK, and Canada. This highlights the power of tax-free investments, something you can explore with municipal bonds or offshore accounts. But be warned, offshore investing comes with legal risks, so always consult a tax advisor. Let's look at the fund's 2025 outlook, which is what you're all here for. Analysts at Goldman Sachs predict the fund could hit $1.5 trillion by December 2025, assuming a 7% annual return, which would add $100 billion to its value tech stocks, despite their volatility, are expected to drive growth, with the Nasdaq projected to rise 10% in 2025. The fund's $20 billion renewable push could also pay off, especially with $100 billion in global green subsidies boosting the sector. But there are risks. A potential U.S. recession, with a 30% chance, according to JP Morgan, could tank tech stocks, costing the fund $50 billion. Rising interest rates and geopolitical tensions, like a possible escalation in the Middle East, could also hurt returns. On the flip side, the fund's real estate portfolio might benefit from a luxury boom in London, where property prices are up 5%. What's your prediction for the fund's future? Before we wrap up, let's address the elephant in the room. What happens when Norway's oil runs out? Oil accounts for 15% of Norway's GDP, but production is declining. By 2030, output is expected to fall 30%, according to the Norwegian Petroleum Directorate. The fund is designed to outlive oil, with its global investments ensuring long-term wealth. In 2025, Norway is investing $5 billion in tech education, aiming to shift its economy toward innovation, with Oslo becoming a hub for AI startups. The fund's withdrawals will likely increase post-2030, potentially to 4% annually or $60 billion to offset declining oil revenues. But with $1.4 trillion in assets, the fund is a safety net that could last centuries. Some estimate it'll hit $3 trillion by 2050. Is Norway the ultimate example of financial planning, or are there cracks in its strategy? That's a wrap on Norway's $1.4 trillion sovereign fund, the world's biggest investor in 2025. We've covered its origins, investments, controversies, and what's next for this financial titan. Is it a safe haven for global markets or a risky bet on tech and renewables? Drop your thoughts in the comments. I'm curious to hear your take. If you love this deep dive, hit that like button and subscribe to Hedge and Haven for more billionaire secrets every day. We drop new videos, and next day we're diving into Switzerland's $3 trillion tax loophole secrets. Don't miss it. Click the bell to stay updated, and let's keep uncovering the financial strategies the ultra-rich use to stay on top. Thanks for watching, and I'll see you in the next video.